Ladies and gentlemen, we're actually early. It's, well, let's call it 5 o'clock in London, 12 midday in New York, 1 a.m. in Hong Kong, 4 a.m. in Sydney, 9 a.m. in San Francisco, and 11:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. My name is Patrick L. Young. The IPO-VID Livestream, Series 21, Episode 6. That amounts to a veritable small fiat of a number. Episode 126 starts here. And where better to start than with a great trading error in the world's power markets. A fat-fingered Finn fumbled the fuses the other day, leaving some folks with free electricity for an hour or two across the nation of Finland, with power priced at minus 500 euros per megawatt hour from midnight to 2 a.m. last Friday. Presumably that was wonderful news for all those with Bitcoin mining rigs. Anyway, there's meanwhile been in the USA embarrassment for the US comptroller of the currency, who did the fintech herd thing, employed a bearded hipster in a polo neck sweater as fintech head, and didn't apparently check his false CV. Meanwhile, new European Union rules on environmental origin may destroy previously warehoused coffee and cocoa. That could have some significant ramifications for EU ports going forward. And then in Ireland, disappointingly, the Irish government, already struggling with being wrong about just about everything in the world, apparently refused to support their stock exchange in a key financial services strategy document. Shame on you, Irish government. And then, ladies and gentlemen, we have, of course, the wonderful world of BitCarnage and crypto, which we cover in our own separate newsletter every day, BitCarnage on Substack. Binance, shaken to its core by a massive criminal indictment, prompted Exchange Invest to query their dogmatic approach to rebutting criticism. We could even put it to music based on a classic David Guetta hit. I'll just read it. I won't try to sing it, ladies and gentlemen, but what are we supposed to do after all that we've been through, when everything that felt so right is wrong now that the FUD is gone? Ladies and gentlemen, our guests today, Stephen Donofrio and Steve Zwick. We're going to be discussing the view to COP28. We're delighted to enjoy the presence once again of ace environmental journalist and financial markets journalist Steve Zwick. He's worked for publications as diverse as the Chicago Reader, Fortune, and Time magazine. He's been twice shortlisted for the World Leadership Forum's prestigious Business Journalist of the Year award. He's produced radio features for Germany's Deutsche Welle Radio and National Public Radio in the United States of America. He's a former futures and options practitioner and trader in Chicago, and nowadays he's writing about the economics of sustainable development and the interplay between land use and climate change. Two subjects he developed a fascination for in a 30-year career that brought him from Chicago's trading pits and led to subsistence farms in rural parts of Kenya, Vietnam, and Brazil. It's an absolute joy to see Steve back on the show, and I'm sure he'll mention his brilliant podcast, Bionic Planet, during the course of the day. Also, delight today to welcome another expert in the field, Stephen Donofrio. He's Managing Director of Ecosystem Marketplace, the world's first and only globally recognized and standardized voluntary carbon markets end-to-end transparency platform. They've been providing exclusive carbon trade pricing data, insights, and news for many years now. Over the past 2 decades, Stephen has held key roles at prominent environmental markets and climate action organizations, including Forest Trends, CDP, formerly the Carbon Disclosure Project. He's also served as a consultant to the United Nations Forum on Forests. And I'm delighted to say once upon a time he worked for the Chicago Climate Exchange, which, as of course you will remember, loyal viewers, was the topic of our discussion just a couple of weeks ago when we had the wonderful Professor Dr. Richard Sander, the founder of that market, in our wonderful studio. So, gentlemen, let's start with that question. Where in the world are you today? Let's start with Stephen Donofrio. Where in the world are you today, Stephen? Welcome.
Just outside of New York City. Great to be here. Thanks so much, Patrick.
Thank you so much for joining us, Stephen. And Steve Zwick, where in the world are you today?
I'm in Rotterdam in the Netherlands.
Wow. So now my masculine intuition suggests to me that the two of you guys are going to be getting together in the Middle East in the near future, I do believe. It's a hectic time for you. I'm so pleased you could join the show. Very, very exciting times as we lead up to COP28. Stephen, tell me a little bit about how you got into this whole voluntary carbon market environment.
Well, it's a longer story than we have for today, I guess. But, the beauty of the voluntary carbon market, or carbon markets in general, is that they provide a pathway for climate innovation, climate solutions, and the ability to invest domestically and internationally in exactly that. So that's what drew me into it in the first place. And you mentioned my former boss, Richard Sandor. It was really that ingenuity and innovation in those early days of the voluntary carbon market, operating outside of compliance systems, outside of regulation, encouraging companies and investors and developers and organizations around the world to do something that they were not required to do to tackle climate change and sustainability issues. So that's what drew me into this concept, was this unbelievable opportunity that the world had before it, to go beyond what the governments were asking us to do, going beyond regulation, and trying to develop as many new ways to tackle the climate issue as possible, while also making sure that they're actually achieving the benefits that they're setting out to do. So that's been it's been a nice long road, longer than I thought it would be. When I started off going down this path, but it's very exciting, and I love every part of finding ways to bring in new money and existing money to tackle climate problems, while also ensuring that there's a return on that investment.
Very interesting. So we're looking for a return on investment. At the same time, we're curing or seeking to cure a lot of the climate imbalances, let's put it that way, as we're going around. And obviously you're focused very much on the voluntary carbon markets. Tell us a little bit about, you've just published a report today, I do believe.
Yep. Yeah, we every year, and now it's becoming more frequent than every year, in an interim basis, we'll be providing more reports. But the title of it, which many people may know, is The State of the Voluntary Carbon Markets. It's been published since the mid-2000s. We've been Ecosystem Marketplace is a program of a nonprofit called Forest Trends. The name that we have may insinuate that we're actually a marketplace. We're not. We're the best way to think of us is the Bloomberg of carbon markets, of environmental markets. We are a data repository. Although the majority of the data we get is confidentially disclosed to us by a global network of over 270 market participants. So these are project developers and resellers of credits that otherwise there is no obligation for them to report this data. We started down this pathway because we knew money was flowing. We didn't exactly know between which parties who were buying the credits, what those prices were. And so for us, we really felt like that transparency is critical, is such a fundamental underpinning of market integrity in order to unlock financial flows that are really needed to invest in this space. So the report we published today is the latest in this series. It's titled the 2023 State of the Voluntary Carbon Markets, but the specific title is called Paying for Quality. And the reason why we focused on this is because what we've been tracking over the past few years is this migration away from, purchasing based mostly on price to preferences around projects that are delivering on climate benefits in addition to other benefits that are supporting local communities or indigenous peoples, that are preserving, protecting biodiversity, that are doing other things for the environment beyond climate. So we saw that progression starting to happen, but now we're seeing not just a preference for those credits, but also a higher price being assigned to those projects. And that's what's keeping the market value up. While the market is slightly depressed, we're seeing transaction volume coming down. We actually see that as more of a consolidation, more of a refinement of the buyer purchasing strategy. Although we are seeing some of the secondary market taking a step back as some integrity initiatives are getting their final platforms off the ground. We are also seeing that end users are continuing to buy these credits. They know that the climate is not repairing itself. They know that there's a liability that the carbon markets can offer them as a solution. And so we're still seeing these companies, buying credits, but they're buying the higher quality credits at higher prices.
Steve, take it away. I'm sure you've got lots to discuss here with Stephen, and you know much more than I.
Yeah, and I should point out I worked with Stephen for a bit at Ecosystem Marketplace, so I know a little bit about the past trends that have been going on, and it's interesting when he talks about the increase. People are willing to pay for increases in quality, because I recall when I was involved, and it's been a few years, but the interesting thing we used to find back then, Stephen, was that the problem we were facing was buyers weren't really willing to pay extra for high quality, for additional attributes. The way it was phrased back then was that all things being equal, they would take the one with the attributes, but they weren't paying a premium. I'm curious as to when that trend started. When did prices start to go up for these high quality offsets you're talking about?
I think we really started to notice it in 2021. Mm-hmm. But at that time, the overall market price on average was just around $4 a ton. So still, a market that had a very, the spreads here, could be around $100 depending on the project type, the location of the project, the vintage of the credit. You name the factor, it can help you kind of think about, what the price point should be. But in 2022, we saw that price, jump up to over $7.30 a ton. And again, spread prices are wide. Forestry projects can get, anywhere from a couple of dollars a ton to over $100 a ton. And it's in that focused area of forestry and land use, agricultural projects, that we're seeing that continued interest in carbon projects. And I think, some of the outside factors that have to do with that price increase in the last few years, I mentioned integrity initiatives, but there's been a lot of different, almost like a myriad of different organizations that are tackling different parts of the quality, challenge, whether it's the standards that are updating their methodologies and ensuring that they're more inclusive of Indigenous peoples and local communities, whether it's the integrity initiatives that are working with companies to say, if you're buying carbon credits as a climate goal, this is how you do it. This is what emissions you can assign those credits to. All of that is coming together into a perfect good storm to show that, yes, credits can be used. If there are quality criteria, here's what they are. This is how you purchase them. And then ultimately, the market, as any market should, it should figure itself out. The lower quality stuff, the prices should decline because they're not in favor. Demand is low. And then the higher quality projects, those credits, should increase in demand, and therefore the supply of them also has been limited due to a slowdown in issuances, and that's also driving up, prices. So there's dynamics around kind of the wants and needs from the demand side, the ability to get that supply because of actual, limited availability, and that's all kind of encouraging the price. It seems to be going up.
Mm-hmm. Can I ask another question, Patrick?
Please,
or are you okay?
Go ahead.
Yeah, because one big issue in the past year, as you know, has been the negative publicity around REDD+ credits. REDD+ is reducing emissions from deforestation and degradation of forests, and a flurry of pretty nasty media reports came out claiming that these emission reductions weren't real. I will argue that most of these critiques were kind of bogus, but there was some were legitimate. I'm wondering if you've, from your perspective, have these critiques, like what has been the impact on REDD+? Has there been has it been a matter of perception leading to prices rather than reality leading to prices, or have there been cases where I guess one project we can mention by name, the Costigal Corridor project, which was one in Zimbabwe, where it turned out there was some sloppy bookkeeping, and that's a case where I can see why people might want to back away from that. Whereas other projects that had some negative publicity was quite frankly a case of the reporters not understanding how methodologies work. Have you seen the buyers are actually aligning their prices with the real quality, or are they responding to the perception and to mistakes made by people who don't really know? what they're writing about.
Yeah. Well, I mean, we talk mostly to project developers and resellers, and we ask those questions. So what I'm sharing with you is what I hear from them. I think there's still a pretty consistent message that prices are lower than where they ideally need to be. We're talking about different price factors where some prices are the bare minimum, other prices will allow you to do X much more in terms of engaging with local communities, ensuring deforestation doesn't happen within the project boundaries or within neighboring boundaries, so there's no leakage. I mean, the more these projects can get for the activity that they're doing, the more that they can ensure the viability of these projects into the long run. But I think to your question, we've asked that because, and I think you're alluding to the Kariba project, which has been the focus of a lot of great or a lot of media attention, and South Pole, being named as a partner of that. I mean, there's unfortunately always going to be one or two projects that are easy to target and for right or wrong, and I wouldn't opine on the quality of the Kariba project, but what we're seeing though is that there's very targeted actions going on from the media, but the product developers that represent other projects, they tell us that while what the biggest impact they're seeing is that the buy side is just kind of narrowing a little bit, where it's not, tons of buyers. They might have just a handful of really engaged, really high quality buyers who are doing above and beyond methods to engage with them as a product developer. They're going to do site visits. They're maybe hiring outside firms to do due diligence checks. But we're not seeing the kind of the negative impact that maybe one might expect from a couple of bad pieces in the news impacting the entire market, which is great. The whole well is not being tainted. And in fact, Red Plus prices are at their highest level that we've ever recorded, over $10 a ton, creeping up to $11 a ton on average in 2023. So that kind of steady price increase and continued kind of price, maintenance in a way of that category of Red Plus is encouraging to see, and hopefully, we'll hear more and more stories about good products out there as well.
Let me just interrupt you just for a second there, because I got a little bit of audience feedback, gentlemen, as we're here talking about On the Road to COP28 with Stephen Donofrio of Ecosystem Marketplace, and also Steve Zwick, perhaps most famous these days for his brilliant podcast, Bionic Planet. John T, good evening all. An interesting discussion. I couldn't agree more, actually, John T. Isn't this absolutely fascinating? And I'm a passenger for most of it at the moment, but thoroughly engaged in what's going on. Anne Berg, our commodities doyen, who was our expert on this show just a few weeks back. Greetings, gentlemen. Thank you for sharing your knowledge on such an abstruse topic. There you are. There's a great word for you to take away on the plane to Dubai in the course of the next couple of days. Abstrusion. You've been driving Anne Berg to abstrusion. There you go, from the city of Chicago in the freezing cold. Now, let me just ask you here, gentlemen. I mean, you're talking a lot here about how the market's developed. It's interesting, Stephen, you mentioned sort of the market seems a bit depressed and so on. It strikes me, this just looks like growing pains in any commodity market, albeit there's a little bit more three-dimensionality to the voluntary carbon market, for instance, because there's a lot more differences in standards and so on than there is perhaps with, say, grades of wheat or corn. Isn't what we're seeing just a perfectly natural growing pain? Things got a bit out of hand a couple of years ago, and now people have really put in a lot of hard work in order to build a better marketplace.
Steve, would you like to go first, or?
Sure. I mean, I'd agree with that. I think, Patrick, you probably have the best, broadest view of what happens in markets more generally. But that's my perception as well. And is that the market is going through a maturation process. It's interesting what Stephen said about the buyers. I think I'd be curious to find out if it's the same buyers that were in this. For years we had the same buyers coming back into it year after year, and they were people who really understood what mattered and what didn't. The growth seemed to be a lot of newcomers who didn't quite know what was happening. So it'd be interesting to see if that's part of it. But it goes to the issue of market, buyer maturation. And there's another issue that's, if I can, the risk of segueing too soon into something that's kind of the next generation, next level. There's a big change underway in the RED Plus credits that we were just focusing on, which is that the first decade or so, these things really, these things took decades. It took decades for them to get the science down right, and they launched the first projects in 2010, and they were using methodologies that were developed by multiple entities. The whole point of the voluntary carbon standard was not to try to develop its own standards, but to let independent entities create standards. They wrote the rules for developing a methodology. And as these, and we had this period of multiple methodologies being applied in different regions. And one thing they found over the past 10 years is that there are a few key indicators that do seem universally predictive in the very short term, where they're not wrong. They have a very low rate of false positives. They tend to be, if they say there's going to be deforestation in this area, they're right to a high degree, but they do miss a lot. So right now, and Vera has gone through which is the Voluntary Carbon Standard, the body that oversees the verified carbon standard. And I did work for them a lot over the past couple of years, just a disclosure. But they've spent the last 4 years developing a whole new methodology that focuses on the very high probability deforestation areas, and in a way that's much more standardized. So I feel like we're going to have a bifurcation in the market now. We're going to have very standardized projects that are coming online all at once, and then you're also going to have these ones that aren't they're more subjective. A lot of them are one-off. The drivers of deforestation can be charcoalers. It can be, sometimes it's not something that is, what's happening in Brazil isn't always what happens in Kenya. So I feel like there's going to be a bifurcation of the market, which is a kind of maturation. You're going to have a very commoditized, standardized set of credits coupled with a whole set of credits that are going to have to, by nature, remain over-the-counter, one-off transactions. So that is in line with the question you're asking, as I perceive it.
So may I just jump in? So what you're saying is essentially the marketplace looks a bit like my poor understanding of ancient Greek, and having studied it for 3 years, I was always bottom of the class because the other guy was better. But essentially, ancient Greek has sort of one beautiful set of nouns, verbs, and then absolutely nothing agrees with it. And what you're saying here is there's one core path which is larger than one noun or verb, but there's essentially a central core path of stuff that can be very heavily commoditized. But then exceptionalism is going to impact a vast majority of the market. Is that a fair assumption?
Yeah, I think that could be that's how I perceive it. We don't really know. The existing projects haven't been reassessed yet, and they haven't gone through the new methodology. But that is the general perception, is that there is going to be a situation where they're broken into the commoditized ones, and a lot of the areas where we're going to see commoditized projects will be newer projects at the forest frontier, because that's where the drivers are most similar.
Stephen, what could you add?
Yeah, Steve's done a great job of laying out some of these key things here. So, I think we're kind of dealing in a scenario where the climate issue, as I started alluding to in the beginning of this call, requires a much larger investment than it's getting currently, and there's also a very diverse pool of actors who either have an influence on that climate issue because they are an emitter, or they are also potentially a small, medium-sized business that has very small emissions, but is also one of those pools of market participants that we are seeing buying credits, but just maybe not at the same volume as those big emitters might be buying. And we've also seen some big companies that historically have purchased a lot of credits, like airlines like Delta, that at one point they were the largest buyer, no longer buying credits or diminishing their purchasing of credits. So there's also this very kind of wide breadth of buyers out there, from very, very small to very, very large buyers. And when you have that also means it's really not one size fits all, to how you define, a quality project. But there are efforts for those large emitters, more or less the publicly traded companies. There are efforts underway to establish those rules, for what you can buy and how you claim that as part of your climate goal. But for a lot of these other companies, they kind of fall outside of that, whether it's because they don't have the stakeholder pressure or for other reasons. And they might be more open, to projects that don't fit within that quality criteria that's being laid out by these big initiatives. And they may be, still be willing to buy, from standards that are less known or up and coming, brand new. They may also be willing to buy from credits and projects that others aren't looking to touch because they're too risky. But we have to kind of see how this plays out. And I think you're absolutely right. This is a maturation of a market. Markets always continue to mature and evolve. The voluntary carbon market is maybe at most, depending on how you look at it, 3 decades old. So, very, very young in comparison to the other commodity markets that you referenced. So I think we still have a long way to go to continue to develop and evolve this market in the right way.
Yeah, there's if I can add on to that, something I neglected to mention, which is the biggest change coming our way isn't this just the new methodology that Vera put out, but the fact that we're moving into jurisdictional crediting, which is something that has, in theory, that has always been the objective. If you go back and you look at the papers that were submitted into the IP or the UNFCCC back in 2008, there was this agreement that the only way to really address deforestation is through large-scale finance going into entire jurisdictions, and that just wasn't doable in the early days because we didn't have jurisdictional data. Governments didn't have the ability to see what was out there. We didn't, it was just too big of a problem to really tackle. But since then, we've shifted to where, since the Paris Agreement, we have jurisdictional data, we have remote sensing that is really reliable. And I did a podcast on that with Sasan Sachi from NASA, who, if you get a chance to listen to that one, it was a very interesting one. But the ability to go in at the jurisdictional level and then have individual projects nested inside of it to deal with hotspots is the big change. So you're going to have a couple of things. You're going to have commoditized commoditized payments and large payments, huge payments at the jurisdictional level, with smaller, more commoditized payments at the project level nesting inside of that, and that provides the ability to target site-specific drivers. And that goes to what Stephen was talking about, because it makes it possible to funnel massive amounts of finance into avoided deforestation, into forest conservation, into helping companies or into helping countries build up their capacity to address climate change and address deforestation, which is just such a sticky issue. And there's also a new generation of credits coming in, which are focused on agriculture, climate smart agriculture at the forest frontier. There's new methodologies. These methodologies actually began also around 2010 or so, but it took about 12 years to get them right. And these are based on getting farmers to change from non-sustainable farming practices to climate smart agriculture, where they're locking more carbon in the soil. And that can have a huge impact, because it not only promotes sustainable land management, but it can increase yields if it's done right. So we could have a huge revolution going on, where we're saying, being very optimistic here, but we could see increased yields, reduced deforestation, lots of activities happening as a result of these finance flows.
That's most impressive stuff. And it's always heartening to hear, because actually, gentlemen, I applaud you, because one of the things I think that's so upsetting is that so much of this discussion is around pure play catastrophism so often. And one of the things I love about all the people who are playing in the carbon markets and the voluntary carbon markets is the fact that you're all actually a pretty optimistic bunch. That's not to say there's not a threat down the line, there's not an issue, there's not something to be worried about, but nonetheless, you are trying to prevent any deterioration in the situation, make things better. So let me say that as an outsider. And actually, I mean, allow me to just segue for a moment, give you both a brief rest, and we will move to our finance book of the week. And talking about catastrophism, well, I mean, one of the great catastrophes of the 20th century was the great crash of 1929. John Kenneth Galbraith, the illustrious economist of the early to mid 20th century, was the author of a really, really terrific book. It's a classic examination of the 1929 financial collapse. It's a very readable tome. And most of all, it's aimed around one thing, which is trying to keep people cognizant of what happens when we have huge bubbles that explode and therefore we get crashes, in the hope that we can manage somehow or other to mitigate, there's a good carbon market word, to mitigate the occurrence of major crashes in the future. Our next book of the week will be unveiled on Saturday in the Exchange Invest Weekend Edition. You can catch the Exchange Invest Weekend Edition absolutely free subscribing at exchangeinvest.com. And don't forget, if you want all the news on the bourse business, including, of course, all of the voluntary carbon markets, sent daily to your inbox, you can subscribe to Exchange Invest via exchangeinvest.com at a mere $349 per annum. If, of course, you want to get really deep into the woods of what's happening all about the world of precisely voluntary carbon in its many ways, shapes, and forms, then I thoroughly recommend to you Ecosystem Marketplace, whose principal is here today. So, Stephen Donofrio, on the road to COP28, you're not quite in Dubai yet. What are you anticipating, and I'll bring you in on this in a second, Steve, what are you anticipating seeing at this year's conference?
Yeah, well, you know, in the voluntary market, there's it's no longer in isolation from the rest of actions and activities to address climate. And what that means is there used to be a day where the United Nations had its own compliance program. There was something called the Clean Development Mechanism. That was the way that you could develop carbon credit projects for the compliance market. And then there was the voluntary market over here, and they were separate. But now the pool of supply of credits that are eligible, for compliance markets is increasingly interwoven with the pool of supply of credits, that companies and others are using from the voluntary carbon market. And so what's really important to start to see is after in 2015, the Paris Agreement that we've all heard so much about, that was formalized, but it wasn't until a few years later where something part of that Paris Agreement, Article 6, which gets very kind of wonky and technical, but it really gets into this space of the kind of the renewed vision for how the United Nations can facilitate a carbon market. And how it intersects with private sector activities, but also then how countries can transfer between themselves, units that are tradable, that are saleable, but then the buying country can use, as part of its NDC commitment. So I think what we're, hoping to see, are some big announcements and some, further policy developments and clarity from countries about how they're actually, attempting to deal with this, or how they're attempting to build these national carbon market strategies, because that is more clarity that's needed in the voluntary market. A company buying a credit might want to know whether or not that credit, can actually be used for a voluntary, activity, or if it's already been accounted for as a country that's a sourcing country where that credit's coming from. And if it's the latter, then that's a potential risk for them to have that credit on their books. So I think this is a really kind of great moment to get that to get more clarity on the government policies, that intersection of the voluntary carbon market, to increase awareness around the money that's needed for this market, that the market is moving towards this kind of quality and integrity approach. And that those are kind of the critical underpinnings to making sure that that this market can be viable into the future, and it can grow. A $2 billion market as it was in 2021 and 2022, that's still very small. This market has an opportunity and has the potential to grow many times that, if in the right conditions. So that's what we're looking for to see in COP28 and beyond.
The excitement of growth, that's going to be absolutely wonderful. Steve, tell us about your view as you're heading towards Dubai.
No, I agree with that. I think one thing that's important to point out is within Article 6, there's two components that are Article 6.2 it relates to how countries trade between themselves, among each other, and they set the rules that have to just fit broad general guidelines. Article 6.4 is a lot more prescriptive. It's something that the UN is creating itself. It's much more of a centralized hub. The big issue now on that one at this COP is going to be the guidance on how to account for removals, which could be pretty contentious, removing carbon from the atmosphere. And that could be contentious just because it's always difficult to get agreement between multiple countries, whereas with Article 6.2, countries can negotiate that among each other, among themselves. And then also the issue of whether REDD+, which I keep bringing up, it's near and dear to my heart, but whether those credits will be recognized under Article 6, because there's some countries are arguing that it gets really long. It gets really kind of pedantic, it may seem, but there's this issue of is it a reduction or a removal, or is it an avoided emission? And there's an argument that shouldn't be allowed in. Some countries say it should, some say it shouldn't. We won't really know until they start laying their cards on the table where everybody stands, but we have a pretty good idea that that's going to be fairly contentious. Although I think the big thing, this year, the big issue is the global stock take. And the global stock take, they've already come out and they've realized that the NDCs are nowhere near deep enough. The emission reductions are nowhere near deep enough to get us where we need to be. So at this COP, what they're really going to be focusing on is A, acknowledging that we're far behind, and then B, coming up with a roadmap so to the next stock take in 5 years, making sure we actually have mechanisms in place to ratchet us down. And the carbon markets will have to play a part in that. What's interesting is that the COP president has explicitly stated his desire to get actively involved in quality issues around the voluntary carbon market. No COP president has ever said that before, and it's not quite sure what that means, because as you know, he's head of the National Oil Company. There's a lot of mistrust, and a lot of people aren't really sure where he stands. Some people are arguing that because he comes from the oil business, he'll have their ear, they'll listen to him. Others are saying maybe he's just, playing games. I don't really know where I stand. I'm just reflecting what I've read. But the final thing I wanted to mention is on these, we talk about the COP, but the real issues, especially where voluntary markets are, it's going to be at the country level, and it's going to be at the societal level. It's not quite clear what can happen at the UNFCCC level on quality measures for voluntary carbon. The big emphasis is on claims. This has kind of been the sticking point of the last few years. If a company says we offset our emissions by purchasing credits, now there's a renewed emphasis on focusing on what can a company say. And most standards and most people are saying they can't really say they offset, but they can say they contributed to emission reductions more globally. And that's a big change.
That's really interesting. Now, I'm kind of going to adopt my perplexed face at the moment, because there's something there I don't understand. It's a really, really useful scenario, and it's very interesting to hear you talking about the politics of what's going on without there being a particular right or wrong. Simply, we're looking at the debate. But you talk about this issue in relation to sort of the quality of the credits, the substantive credits that are being bought by corporates, and whether they're sufficient for purpose, etc. Is that currently very subjective, or is that becoming increasingly objective? And I'm probably just showing my complete ignorance because I'm not on the road to COP like you two gentlemen.
Steve, do you want to go first, or should I go first? Or
well, go ahead, Steve. I'll jump in after you.
Yeah. I mean, I guess I'd say it's both, and that's kind of what's confusing, because that's the nature of the voluntary carbon market. I mean, the voluntary market by nature is there to encourage companies to go beyond what's required by law, and to experiment with new methodologies and new approaches. And a lot of this goes back to the bifurcation we talked about earlier. There are certain methodologies that are very, very clear, simply because there are certain situations where the threat is very clear, and it's and in a standardized way. I mean, if there's it's like if you look at crime statistics, you can have a guy with a open gun on the street pointing it at people. That's a clear threat. You can have another case where a guy's behaving strangely. What's the case? And so there are some cases where you could say it's more subjective, or And the IPC even talked about this. IPCC talked about this back in the 1990s. Is, you know, if you look at all the models and all the approaches to identifying a threat to the forest, a lot of them are subjective, and that doesn't mean they're necessarily bad. Sometimes logic and common sense will tell you if there's a threat, and you can't necessarily come up with rules for it. So there are some cases where you can come up with very clear rules of engagement to keep that sort of, you know, militaristic analogy there. But and then there are other cases where it's going to be more, it might be more logical, more scenario analysis, or you could say subjective. So it's all kind of all over the place. The challenge is standardizing this.
Stephen.
Yeah, I mentioned a little bit about this before, but the Voluntary Carbon Markets Integrity Initiative, which actually just today published a new and I believe the final round of guidance, around their the claims code, which is getting to this point about whether or not there is standardization or some sort of global acceptance around how companies can account for carbon credits and their climate strategies. And what's really interesting is that today they unlocked a new pathway, which is to use up to a certain percentage, carbon credits to address Scope 3 emissions. And Scope 3 emissions are typically the most challenging for a company to tackle. They're the value chain emissions, the ones that are upstream, where you're sourcing your raw materials from, or could also be employee travel. It could then also be the use of a product downstream, thinking about an oil and gas company, if they were really to report on Scope 3 emissions, that Scope 3 liability would be much larger than other scopes because of the use of those fossil fuels. And similar for financial institutions, invested emissions are a hot topic issue for that sector as well. So I think what we're kind of seeing there, though, is this: it's more about the accounting side of it for a company, and making sure that there is something that a company can stand behind and say, look, I did it according to best practice, or what is considered to be the way that most will agree is the right way. And then there will be companies that, like I said earlier, operate outside of that public view, or outside of that scrutiny, and maybe are purchasing lower volumes and just kind of dabbling in the market. And so I think there's sort of a little bit of a mix of it all, but we've never really before had these platforms and these initiatives drilling down in such a kind of market-wide way to get acceptance across the board, including the people on the ground, the indigenous organizations and local communities, making sure that they're at the table, and making sure that part of what companies need to be reporting, that's required is that revenue sharing, to on the ground actors, so that kind of financial transparency, within kind of the market and within the project activities themselves. That's also helping to bring more trust, in different ways to the market.
That's very interesting. Bringing more trust to the market. You're also talking about hydrocarbons and things like that. And if I may, here's quite an open question. I'm not sure what you can add to it, but it's a very interesting question, whether we can answer it or not. I see Anberg says EIA is projecting record natural gas, LNG, and crude production in the US over the next few years. And indeed, I do believe at the moment the US is actually exporting LNG and crude oil at the highest levels it's ever done in history, if my memory serves me correctly. Is there still potential for cleaning these fuels before they are utilized, consumed? That might be a little bit off topic for you guys, but it's an interesting question.
Well, I assume by cleaning, we're talking about buying carbon credits. If you're an energy producer or a distributor, and using that to neutralize the climate impact, of either the sourcing or of the use of those fossils. And I think this is kind of at the center of some of the debate, where people will say, well, yeah, we can't really deal with carbon credits until we tackle all of our direct emissions and reduce those along with climate science. then in maybe 5 or 10 years from now, once we've done that, we can then move on to carbon credits. And the other people will say, well, what about all those emissions that are going, unaddressed, that are coming out of, your what might be a 5 to 10 year investment to deal with, direct emissions? Then how do you account for those, or do we just let those emissions go out into the atmosphere and provide no pathway for companies to get recognized for offsetting them or going carbon neutral with those fossil fuel deliveries? So I think this is like a really important topic, and also a really important opportunity when we also think about scope 3, which is what I mentioned before, because this could be, in a lot of companies, scope 3. So whether it's the energy company, that's investing in the carbon neutrality of the nat gas, LNG, or crude production, or it's the buyer who's sourcing that in order to operate their businesses. And so that's why these guidance from the Voluntary Carbon Markets Integrity Initiative and others are really helpful to give clarity about who should buy and how they can use it.
Steve.
Well, on this, I don't really know enough about liquid natural gas and stuff like that. I think what Stephen said is what I would say.
Right.
I mean, I just it comes down to, because this is the thing in all this. The issue you kept coming up with is what's subjective and what's solid, and a lot of this, the way all of this stuff works, most of it, this isn't like, physics. This is physics. This is biology on top of physics, and then human behavior. So what you do is you look for this sweet spot where expert views align and say, okay, we, through this consultative process, this is what we've agreed to. And people always debate that. And I don't know that one, that whole LND, I focus on land use and climate change. I don't focus on the industrial stuff that much.
So, but essentially what you're saying is we've got a big bell curve of possibilities, and as long as essentially you're getting yourselves pretty much somewhere in the generally central area of the big fat part of the bell curve, then that's the area where most people agree, and we're pretty consistently certain that there's going to be a positive outcome, right?
Yeah,
good.
I'd say that. Yeah,
that's it. So, I mean, Stephen, tell me, you're looking forward to COP28. We've got a situation at the moment where I think the last few years, exchanges were talking a lot about what they were doing, et cetera, et cetera. We've had a large number of exchanges grow in this space and so on. I appreciate, Stephen, that your business is a lot about the whole market, and holistically, the OTC market is much, much bigger than the exchange business per se. But what do you think we're looking at in terms of how the markets are going to get together during COP and post-COP, and if there are any big changes that might cause a major upheaval for the established markets?
Just like most things when it comes to voluntary market or climate change in general, I stand behind a perspective that we need every option possible. And so although our work largely is to track the OTC voluntary carbon market, we're very aware that there's a very strong use case for exchange traded products, and those products need to be underpinned with as high quality of data as possible to be a reference price. But also we need to make sure that that the buyers know what they're buying, and that there's clarity about whatever risks they might be taking when buying a contract, and that this market, as you said earlier, is still developing and is going through a maturation phase. So there are uncertainties. There could be potentially other projects called out, just like Steve was mentioning earlier about a couple of RED Plus projects. But that's part of the risk that you take on when you come into the voluntary carbon market, because when you buy a contract, you may not explicitly be able to direct yourself or direct to what credits you're buying and which project you're buying from, but it might just be that it's meeting certain criteria. So I think that's kind of where I loosely stand on it. I'm very kind of passionate about all forms of credit transactions, OTC and exchange traded.
Cool. Steve?
Yeah, I've actually got a quick question, and it relates back to what we opened with, the very, very opening of today's show. When you talked about the demand and the willingness to pay extra for projects that have these additional attributes, the ways I'm wondering if there's any evidence that the attributes are really being measured by a lot of these standardized approaches and labels that standards have come up with for identifying the benefits that a project generates on that support individual sustainable development goals, the SDGs, because that is huge right now. If we can get money flowing into projects that support, say, equal pay for women, or water as well as climate, projects have been bending over backwards and spending a lot of money, quite frankly, to have third-party auditors come in and follow these methodological standardized approaches to seeing whether their projects are actually generating these benefits. And I know when I was working with you, we found that this was also it wasn't really catching on. And I get the feeling from you that it has caught on. And I guess the question is, if people are following that, do you think there could be demand for the next phase where they're talking about separate credits for, distinct units under the SDGs, such as, I know that Vera and Gold Standard are both working on credits for that equate to the number of reduced hours of drudgery. I'm wondering if that is something that you're seeing any evidence that this, what they've been talking about forever, is that really actually coming into fruition right now?
Yeah, well, when we talk about premiums for projects with co-benefits or SDGs, I mean, these are not self-declarations necessarily from the projects. So when we talk about co-benefits, it is whether or not the project has a certification from the kind of the three kind of best known ones and developed ones are the Climate, Community, and Biodiversity standard, SD Vista, and social carbon. And largely, these certifications are tacked on to the Vera credits for VCS, which is the largest carbon crediting standard, and VCS is the largest source of credit supply other than potentially the CDM. And so that's how we look at it. But when we do that analysis, we have product IDs associated to the transactions that are reported to us. So we're able to make sure we can go back to that registry data and pull in, the details about those co-benefit certifications when we do that analysis. And so just to kind of say, there is a kind of a diligence effort on our side when we do it that way. And then in terms of SDGs, I think the difference of when maybe you were dealing with this, some years ago to now, is that over the last few years, all of these carbon standards, at least the main ones, and in part, it's because it's a requirement for CORSIA, which is the kind of the offsetting program for international aviation. It's a compliance market for international aviation. Required that these standards, have SDGs as a part of, the projects that are eligible, for that compliance market. So that kind of encouraged all these standards to bring in those attributes, or at least allow for there to be a process in which the projects, declare what SDGs are associated with their projects. Then in many cases, those get third party, verified, or that's part of the monitoring that happens as a project. In which case, then you have data at the registry level, again, associated to the projects specifically that identify those sustainable development goals. So that's how we do it, and we try to make sure that we're very careful about not letting in self-reported data at this point, because it needs to be rigorous. We need to be sure that when we talk about price premiums in any case, that it can be backed up with actual data.
Stephen, we've got barely 5 minutes to go. It's time for our blue sky thinking part of the show. I'm going to ask you each the last question. First of all, I'm going to ask Stephen Donofrio. Stephen, where do you think the capital market revolution goes next?
Well, just a moment ago, Steve alluded to this, and it's this idea that if we can get the voluntary carbon market, to work right and to be, successful, it will open up avenues for other markets, biodiversity markets, or water markets that maybe have existed in different ways, maybe more niche, markets and more local markets. But I really see that we're finally understanding as a global community that there's a value to our climate, there's a value to nature, there's a value to people and planet, biodiversity. And we need to make sure that that price can be, affirmed, and it can also be backed up, and that there's a global recognition of certain prices that really do set the mark, for opening up opportunities for other markets.
Steve Zwick, where does the revolution, capital market revolution, go next?
Yeah, I'd actually agree with what Stephen said, and just maybe phrase it a little bit differently, which is that I think we're going to see payments for ecosystem services markets go from being regional to being more global. Right now, in the US, in the UK, you do have water markets, you do have biodiversity markets, but they're related to if there's a company that does a development and they impact an area and they hurt habitat, they have to restore habitat of equal or greater value, or a watershed or wetland. And that's because it's a direct impact. What we're moving towards now is this trend towards nature positive that's always been theoretically been there, and companies have always said that they want to make sure they're actually delivering the benefits they say they're delivering. And I think if you look at this stuff, the science is really strong. It's those claims can be made. I think the big challenge is going to be communicating it, because it's hard to explain how these methodologies work. And if you get someone who doesn't want to put in the time to really understand it and question their premises, and they decide to go off half-cocked and say, oh, it doesn't work, or it's a scam or whatever, it could all go pear-shaped. So I think we need, as long as we have good communication, good explanatory material around this, and help people understand how it works and why we need it, I think we will see this next shift to nature positive, in a market-based way.
Nature positive. What I'm hearing are all the messages that we always hear actually about markets and their growing pains in so many ways: integrity, trust, audit, communications. We've had a lot of conversation today about the co-benefits therein. This is, of course, a much more complex market to evolve than something that's a very mono market by definition, or say produce quality. Although at this stage, I think probably our excellent questioner, Anne Berg, will jump down on me and say, well, there are a million different variations on corn. And you're not wrong there, Anne. I understand very much the complexity of commodity markets that are the same as many of the complexities in carbon markets. Stephen Donofrio, Steve Zwick, it's been a pleasure to have you on the show today. Absolutely marvelous. Ladies and gentlemen, do go and check out Stephen Donofrio's latest report with the fantastic ecosystem market team. That's on the road to COP28. I must say, I'm rather optimistic for once about a COP conference, simply because we haven't heard these astounding grandstanding statements as we go along. It looks to me like there's a lot of detail work to be done there. And in that respect, I think we can be confident that there's a lot of technocratic activity, which is going to build us a better market in the near future as we become increasingly nature positive. What can I say? Steve Zwick referred earlier on to this whole fascinating concept of the reduced hours of drudgery. All I can say, ladies and gentlemen, is I definitely do not believe this qualifies as an hour of drudgery in any way, shape, or form. It's been hugely productive. Thank you very, very much once again, Steve Donofrio, Steve Zwick. I wish you all the very, very best at COP28. Next week, we're going to be hearing from Chris Rhodes, who's going to be coming to us from the London Ice House. He's the head of Ice Futures Europe, and therefore a key player in so many markets around the world. Of course, Gordon Bennett, his head of environmental markets, is going to be at the COP conference during the course of next week as well. Ladies and gentlemen, it only remains for me to say thank you once again to all those people who contributed today. Thank you, John T, once again. Thank you, Anne Berg, for your excellent question. And I want to say a huge word of thanks to Jamil, Racy, and Rachel, who've done such a smooth job in producing our excellent guests on the road to COP28, Stephen Donofrio and Steve Zwick. Thank you very much for watching. We'll catch you next week. Gentlemen, I wish you a wondrous, low emissions and very productive COP28 in the UAE. My name is Patrick L. Young, wishing you a great week in life and markets.
Thanks.
Thank you.